Welcome back to the Deep Dive. Today, we are opening up a stack of research that I think is going to make some people a little uncomfortable.
Oh, yeah.
We're looking at market data, behavioral psychology studies, and some pretty hard-hitting financial analysis that all points to one thing.
Which is?
A lot of us are operating our financial lives based on zombie ideas.
Zombie ideas. I love that term. It's perfect for finance.
You know exactly what I mean, right?
Yeah.
It's those ideas that they refuse to die.
Right.
They get repeated at dinner parties. They're in the headlines. Your uncle swears by them. And because they're simple and, memorable, they feel like the absolute truth.
But the sources we're covering today suggest that one of these truths is actually, well, a trap.
A trap.
Right. And what makes this trap so dangerous is that it's not the kind that snaps your leg off. It's not a Ponzi scheme where you lose everything overnight.
Yeah.
This is much more subtle.
The sources use a phrase that really stuck with me. Quiet underperformance.
Exactly. Quiet underperformance. It's the tragedy of thinking you're doing everything right. Following the rules, being responsible.
So then what?
Only to wake up 20 years later and realize you've left a massive amount of wealth on the table. You didn't crash. You just sort of slowly leaked potential.
That is almost scarier than a crash. A crash, you notice? A crash makes the news. A leak you might not see until you're sitting down with a financial planner at age 65.
Yeah.
And the numbers they don't add up.
Right.
So today, we are going on a mission. We are taking a sledgehammer to rule #6 of conventional investing wisdom.
This is a big one. It's practically sacred ground for a huge demographic of investors.
Especially retirees, right?
Especially retirees. We're talking about the belief that dividend stocks give you free income.
I can already feel the tension through the microphone. Dividends are free money.
Yeah.
It's the ultimate comfort blanket, isn't it?
It is.
You buy a stock, the company sends you a check every quarter, and you still own the stock. It feels like magic. It feels like a bonus.
It feels like a golden goose laying golden eggs. But today we need to do a little biology lesson on that goose.
Okay.
Because the reality, and the math here is just undeniable, is that a dividend is not a magical creation of value. It is strictly a transfer of value.
A transfer.
And misunderstanding that one little mechanic is one of the single biggest reasons investors underperform.
Okay, let's get right into the weeds then. Because I think for most people, myself included, the mental accounting goes like this. I have $100 in my brokerage account. I get a $2 dividend check. Now I feel like I have $102. Are you telling me that is objectively wrong?
I am telling you that is an optical illusion. Let's walk through the mechanics because, the numbers don't lie.
Let's do it.
Imagine a company, let's call it Acme Corp, and it's trading at exactly $100 per share.
Okay, I've got one share of Acme. It's worth $100.
Right. Now, Acme has some cash sitting in its corporate bank account. That cash is part of the company's value. It's already part of that $100 share price. Okay.
The board of directors decides, you know what, we don't have a good use for this cash, so let's give it to the shareholders. They declare a $2 dividend.
Great news for me. I'm waiting by the mailbox.
Sure, but here's the physics of it. On the pay date, they take that $2 out of the company's bank account and wire it to yours. What happens to the share price the moment that transaction clears?
In my gut, I feel like it stays at $100 and I have $2 extra. Maybe it fluctuates a little with the market, but basically 100.
And that is the myth. In reality, on what's called the ex-dividend date, the exchange strictly adjusts the share price down by the exact amount of the dividend.
Wait.
So they pay you $2. The stock price immediately drops to $98.
Wait, it's automatic. The market just decides it's worth less.
It's not a decision. It's arithmetic. Think about it like an ATM.
Okay.
If you walk up to an ATM and check your balance and it says $100, you withdraw $20 cash, you now have $20 in your hand, what does your bank balance say? It is $80.
Exactly. You aren't $20 richer. You just moved $20 from inside the bank to inside your pocket. A dividend is the corporate equivalent of an ATM withdrawal. The company is literally worth less because that cash has left the building.
That is such a clear way to visualize it.
Yeah.
So let's do the total math on my Acme stock then. I had a $100 stock.
Yep.
Now I have a $98 stock and $2 in cash.
Correct. And 98 plus 2 equals?
100.
100. Precisely. Your net worth hasn't changed by a single penny.
Wow.
You haven't gained income. You have simply moved value from the invested column to the cash column.
So it's like taking money out of your right pocket, putting it into your left pocket, and high-fiving yourself for making a profit.
That's a perfect way to put it.
That is distressingly unmagical when you put it that way. It really takes the shine off the free money idea.
It does.
But I have to play devil's advocate here, and I know our listeners are thinking this. So what?
So what is the right question?
Yeah, I mean, if the total value is the same, why does it matter? If I have $100, either way, isn't it better to have the $2 in cash? I can buy a coffee with cash. I can't buy coffee with a stock certificate. Why is this a trap?
It matters because that transfer isn't frictionless. When you move that money from the right pocket to the left, two invisible hands try to grab a piece of it.
Oh.
We're talking about taxes and control. This is where we get into the hidden costs our source material highlights.
Oh, the leak in the portfolio. Let's talk about taxes first, because everyone hates taxes, but we usually just accept them as a fact of life.
Think about it this way. When a company pays a dividend, they are effectively forcing you to sell a tiny piece of your investment.
A forced sale. I've never heard it described that way.
But that's what it is. You didn't choose to liquidate that $2. The company decided for you.
Oh.
And because that cash hit your account in a standard brokerage account, that is a taxable event.
Ouch. So the IRS gets involved immediately.
Immediately. You have to report that income. You have to pay taxes on it. Even if you didn't need the money, even if you just wanted to let it grow.
You have zero control.
Zero control over the timing. And that interrupts the compounding. Right?
Drastically, I'd imagine.
Drastically. It's what we call tax drag. Imagine you're rolling a snowball down a hill to make it bigger. A dividend is like someone stopping the snowball every 100 feet, shaving a little ice off, handing it to the IRS, and then letting you keep rolling. Over 20 or 30 years, those little shavings add up to a huge difference in the final size of the snowball.
Versus a stock that just keeps the cash and grows.
Exactly. Compare that to a company that doesn't pay dividends, maybe a growth stock. It takes that same $2 of profit and reinvests it.
Into what?
A new factory or R&D or buying a competitor. The stock price grows from 100 to 102.
So I have $102 of value.
You have $102 of value, but have you triggered a tax bill?
No, not until I sell the stock.
Bingo. You control the timing. You decide when to take the tax hit. Maybe you wait until you're retired and in a lower tax bracket.
Or maybe never.
Maybe never. You could leave it to your heirs to get a step up in basis. With growth, you control the valve. With dividends, the valve is stuck open and it's leaking taxable income every quarter.
That makes so much sense. It's about efficiency. But let's pivot to the other big reason people love dividends, maybe even more than the money itself.
Ah, yes.
Safety. The sleep well at night factor. There's this deep-seated feeling that a dividend stock is a safe stock. Even if the market goes down, even if the chart is red, at least I get my check right, it feels like a bond. It feels like a contract.
That is the illusion of safety. And the source material is very, very blunt on this. Dividends are not guaranteed.
They're not.
They're not a bond coupon. A bond is a contract. A company must pay you or they go bankrupt. A dividend is just a policy. A company can cut, slash, or completely eliminate a dividend on a Tuesday morning without asking for your permission.
And we have seen this happen. This isn't just theoretical fear-mongering.
Not at all. The source points to two major recent examples that really shattered this illusion. You look at bank stocks in 2008 or big energy companies in 2020.
Right. Before 2008, bank stocks were the definition of safe income. Grandmothers owned them.
They were widow and orphan stocks. Safe, reliable yield. And then the crisis hits.
And what happens?
It's a double whammy. First, the business struggles, so the stock price tanks. That $100 share might drop to $50. You've lost half your principal.
And usually the investor says, well, I'll just hold on for the dividend. I'll get paid to wait.
Right. But because the business is struggling, what's the first thing the board does to save cash?
They cut the dividend.
Cut it to zero. So you lose the reliable income exactly when you might need it most, and your principal investment has crashed.
The safety net disappears right when you fall.
Exactly. So relying on dividends as a safety mechanism is a flawed strategy. It ties your income stream to the decisions of a board of directors who are trying to save the company, not your personal retirement budget.
Okay, this is pretty heavy. We are smashing the myth that dividends are free money, we're acknowledging the tax drag, and we're debunking the safety aspect. But I can hear our listeners screaming at their speakers right now.
I need the cash.
Yes. This is all fine and theoretical, but I'm retired. I can't pay for groceries with unrealized gains.
Right. I can't eat stock appreciation.
Exactly. I need money in my checking account. If we take away the dividend strategy, what is the alternative?
The alternative is shifting your mindset from yield to total return.
Total return. That sounds like finance jargon. Let's unpack that.
It's actually very simple. Total return is the complete picture. It's the stock price appreciation plus any dividends paid. The source argues that you should focus on maximizing that total number, the size of the whole pie, rather than obsessing over how the pie is sliced.
So give us a comparison. How did this look in practice?
Okay, let's look at two hypothetical investments. Stock A is a dividend darling. It pays a 4% dividend yield. But because it pays out all its cash, the business doesn't grow much. The share price stays flat.
Okay, so I get $4 in cash, stock stays flat, my total return is 4%.
Right. Now look at stock B. It's a quality compounder. It pays 0 dividends.
Okay.
It reinvests all that cash back into the business, new products, new markets. Because of that, the share price appreciates by 8%.
So my total return is 8%.
Exactly. 8% beats 4%. It's simple math. But the dividend investor often chooses the 4% simply because they get a check in the mail, even though they are ending up with significantly less wealth over time.
The bird in the hand.
They prefer the bird in the hand, even if the bird in the bush is an eagle.
But here is the snag, and this is the mental block. Stock B went up 8%, which is great. I'm richer on paper. But how do I get cash out of stock B without a dividend? Do I just stare at my account balance and feel good?
This brings us to one of my favorite concepts from this deep dive. It's called the homemade dividend.
The homemade dividend. It sounds like something I'd bake in the kitchen. How does it work?
It's very empowering. Instead of waiting for a board of directors to decide to send you a check, you create your own check.
Oh.
You simply sell a small portion of your shares.
See, that's the part that scares people. Selling shares. It sounds like I'm eating my seed corn. If I have 100 shares and I sell 4, now I only have 96. I'm slowly disappearing.
I get that fear. It feels like you are liquidating the business, but you have to go back to the math we started with. Remember, a dividend reduces the share price. Selling a share reduces the share count. In both cases, you are extracting value from the portfolio.
Walk me through the math on the homemade version. Let's make it real.
Okay. Let's say you own $100,000 of that growth stock B. It goes up 8%. So now you have $108,000.
What?
You need $4,000 cash for your living expenses.
So I sell $4,000 worth of stock.
Right. You sell the shares. You have $4,000 cash in your pocket. You have $104,000 remaining in the investment.
Right.
You still have more money invested than you started with, even though you sold shares.
Because the growth outpaced the withdrawal.
Exactly. As long as the total return represents real growth, selling a few shares doesn't deplete your portfolio any more than receiving a dividend does. But, and here is the kicker.
What's that?
The tax treatment is usually way better with the homemade version.
How so? This connects back to the tax drag we mentioned earlier.
Think about the dividend. You pay tax on the entire amount of the dividend check. $2 check, tax on $2.
Right. It's all considered income.
But when you sell a share, you only pay tax on the gain. This is crucial.
The profit.
The profit. If you bought a share for $50 and sold it for $100, you only pay tax on the $50 profit. You get your original $50 back tax-free.
Oh, wow. I never thought about that distinction.
It's huge. So if you create a homemade dividend of $4,000, you might only be paying taxes on $2,000 of it, depending on your cost basis.
And if you've held the stock for over a year, you're paying long-term capital gains rates,
which are typically lower than standard income tax rates.
So let me get this straight. Creating a homemade dividend lets me, A, potentially get better total returns, B, control exactly when I get the cash, and C, pay significantly less in taxes.
You nailed it. It is a more tax-efficient, flexible way to generate income.
And it frees you up.
It frees you from being limited to only companies that pay dividends. You can invest in the best businesses in the world, companies like Amazon or Berkshire Hathaway that don't pay dividends, and just manufacture your own income stream from them.
That is a massive mindset shift. It moves you from being passive waiting for a check like an allowance to being active in how you manage your cash flow.
It really is. It decouples your need for cash from the company's decision to distribute cash.
Now, I want to pull back for a second because I don't want us to sound like we are declaring war on all dividend stocks.
Good point.
Are we saying you should never buy a stock that pays a dividend? Are dividend investors fools?
No, absolutely not. And that's a crucial nuance check. We aren't saying dividend stocks are bad. The source material is very clear on this.
Okay, good, because I own some dividend stocks.
And that's fine. Dividend-paying companies are often established, mature businesses with stable models. Think of, consumer staples like toothpaste companies or utilities. They have a place in a portfolio.
They aren't evil, they just aren't magic.
Exactly. They can be a great part of a portfolio. The problem, and the reason this is rule #6 to ignore, is when you build your entire strategy around them.
The yield trap.
Right. The danger lies in the lack of diversification. If you filter the entire stock market and say, I will only buy companies that pay 4% or more, you end up with a very weird, concentrated portfolio.
Mm-hmm.
You might end up with way too many banks or way too many energy companies or sketchy real estate trusts.
And we know what happens when you are over-concentrated in one sector and that sector takes a hit.
Quiet underperformance or loud crashing. If interest rates rise, your utility stocks get crushed. If oil prices fall, your energy stocks get crushed.
So what's the lesson?
A well-rounded portfolio should include growth, it should include value, and yes, it can include dividends. But the dividend shouldn't be the deciding factor. The tail shouldn't wag the dog.
Exactly. The quality of the business and the total return potential should be the deciding factor. If a company's a great business and pays a dividend, fine. If it's a great business and doesn't pay a dividend, also fine. Don't discriminate based on the payout policy.
This has been a real eye-opener. I think for a lot of people, the emotional comfort of that quarterly check is hard to let go of.
It's so tangible.
It is. But when you look at the math, the $100 becoming $98 plus 2, it really breaks the spell.
It does. And once you see it, you can't unsee it. You realize that a dividend is just moving money you already own.
And paying a toll to the IRS for the privilege of moving it?
Exactly.
So let's recap the mission of today's deep dive, because we covered a lot of ground. We took a sledgehammer to the myth of free dividends.
We did.
We learned that dividends are a transfer of value, not a creation of value. Remember the ATM analogy.
Right. We talked about the tax drag that eats away at your compounding and the illusion of safety. Dividends aren't guaranteed, as history has shown us.
And we offered a solution. Focus on total return. Don't be afraid to create your own homemade dividends by selling shares.
It sounds scary to sell, but the math shows it keeps your wealth intact just as well as a dividend, often with a smaller tax bill.
And finally, don't ditch dividends entirely, but don't marry them either. Diversification is still the only free lunch in investing.
Absolutely. The goal is to build a portfolio that supports your life,
Right.
not one that just adheres to an old rule of thumb that might not serve you anymore.
Well said. This conversation brings up a final provocative thought for me.
Okay.
We talk so much in the finance world about passive income. Everyone is obsessed with passive income. Dividends are always sold as the ultimate passive strategy. Just buy it and sit on the beach.
Right. But as we've discussed, that passive strategy creates active problems,
Yeah.
taxes, concentration risk, lack of control.
Exactly. It makes you wonder if the most popular passive strategy actually requires you to actively monitor it to avoid that quiet underperformance we talked about.
Yeah,
Perhaps the definition of a safe investment needs to be rewritten.
it certainly does. This source mentioned this was just rule #6 of 7 bad rules. If this one, which feels so intuitive, so safe, was this misleading?
How many of the other rules are currently sitting in our listeners' portfolios, quietly dragging them down?
That is a question worth asking.
Something to mull over until next time. Thanks for diving in with us.
Pleasure as always.
Catch you on the next deep dive.